To order. It's 9:05. Linda, if you could please read the announcements.
Okay. Thank you, Ms. Sanchez. This meeting is being conducted as a virtual and in-person meeting, so I will do roll call of the trustee to confirm attendance. In second. Okay. Mr. Knox,
Good morning, I am here.
Mr. David Green, Mr. Santos,
Here.
Mr. Jason Green,
Here.
Mr. Rue,
Here.
Mr. Jones,
Present.
Mrs. Jones,
Here.
Mr. Kelly, and Chair Sanchez.
Here.
Okay, staff participating in the meeting include the following: CIO John Grable, CEO Santos Kryman, Chief Counsel Stephen Rice, DCEO Louis Lugo, AEOs JJ Popovich and Laura Guglielmo, Interim CFO Ted Granger, Human Resources Director Carlina Toya, investment staff are Jude Perez, Vache Masarajian, Jim Rice, Christopher Wagner, Amit Agarwal, Mel Chow, Dale Johnson, John Kim, Tara Elijah, Jared Kong, and Calvin Chang. Consultants are the Makita Group, Alborn, Stepstone, and Milliman. Trustees, please use the raise your hand option to be placed in the queue. At this time, we ask all meeting participants to mute their mics until you're ready to speak. And now we proceed with the agenda.
Thank you. At this point, we will stand and Mr. Santos, would you lead us in the Pledge of Allegiance?
All rise. Ready, begin. Pledge of allegiance to the flag.
To the flag of the United States of America, to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Emphasis of justice for all.
Yes. Thank you, Mr. Santos. It's been a while since we've done that, and I'm very pleased. Thank you to Mr. Kelly for reminding us that this is an important part of our meeting. Do we have anybody participating under the procedure for teleconferencing?
We do not.
Thank you. And just as a reminder, I am participating under Brown Act. Next, we have the approval of the minutes.
Move approval.
Thank you. Any seconds or corrections?
Second.
We have a
Mr. Kelly
second?
seconded, sorry.
Well, if Mr. Kelly seconded it, then there are no corrections. Let's take roll.
Mr. Knox,
Aye.
Mr. David Green, Mr. Santos,
Yes.
Mr. Jason Green,
Aye.
Mr. Rue,
Aye.
Mr. Jones,
Aye.
Mrs. Jones. Aye. Mr. Kelly
Eagle eye votes yes.
and Chair Sanchez.
Yes.
Okay, the motion passes unanimously.
Fantastic. Thank you. Do we have any requests for public comment?
We do not.
Great. And before we jump into the full agenda, I'd just like to take a moment to welcome Trustee David Rue to his first meeting. Thank you, and we look forward to your participation. Moving on to the executive update.
Yes. Chair Sanchez, trustees, welcome. Trustee Rue, we look forward to working with you. Wanted to make a very brief report. We did, as you all know, had an offsite to discuss our strategic planning efforts and provide the Board of Retirement some additional educational information. And so I wanted to let you all know that we're in the process of compiling all of the comments that all trustees provided. We plan on coming back to the Board of Retirement for their approval of our strategic plan in April. And so we appreciate all of the efforts by the staff, as well as all of the input provided by the BOI trustees, as well as the BOR trustees. And so thank you for that. I think the process is moving on very well. I was very pleased with the engagement that we had with all of you. And I also wanted to recognize Mr. Grable and his team. Didier did an outstanding job in one of the presentations. And so I didn't want to, I wanted to make sure I recognize them. In terms of our member services, as you know, we're in the middle of March Madness. Everybody's rushing to retire before the March 31st deadline. And so we are extremely busy. down in member services, providing in-person counseling, as well as virtual counseling. And so we're hopeful to be able to get everybody that wants to retire through the process as quickly as possible. We've made some improvements on the call center that I won't bore you all with, but suffice it to say that we've added some additional appointments so that we can process folks, and we're also working on Saturdays at this particular point in time. So in terms of recruitment updates, I can tell you that the Deputy Chief Investment Officer position was very well received. We had somewhere north of 240 applicants. We've gotten it down to, I believe, 9 to 11. We're still vetting, I believe, the 3 additional late applications that we received. And so we should begin the process of interviewing, the first interview process, the end of March will be the first cut. The CTI, the Chief Technology Officer position, I know that's been subject of discussion. We've got through the first round of interviews. There'll be a short list that we provided to myself in the very, very near future. And so we'll begin making a selection for the CTO position, in addition to the Chief Information Security Officer position. We'll be moving those forward as well. We've done the first round of interviews for that position as well. So we're moving along quite nicely. We continue to work with Mr. Grable and his team in terms of trying to figure out the best recruitment method to hire some of his critical needs. And so we're moving forward in partnership with him on that. So I don't have any other items that I'd like to bring to your attention. So I'd be more than happy to stand for questions.
Madam Chair, I have a question.
Yes, go ahead.
So who's participating with the Deputy CIO? Who's participating in the interviews?
So the way we have it structured is that Mr. Lugo, Mr. Rice, our Human Resources Director, Carly, will be doing the
That's
first.
Steve Rice or Jim
Steve Rice. Yeah, Steve Rice. We do have some internal candidates, and so it complicates things a little bit. So they will be doing the first round of interviews. We've also have a subject matter expert that we're bringing in from another agency to assist us with that. And of course, the recruiter will be there also to assist with the interview process. Once that is completed, there'll be a short list of candidates. Mr. Grable will interview them individually, and then I will interview them individually. And then Mr. Grable and I will come together and we'll talk about who we feel is the best fit for LACERA. And then obviously, Mr. Grable will have a tremendous influence on who that's going to be.
Good.
So that is the process that we.
When you say another agency, talking about another pension agency, or don't tell me it's LA County.
It's another pension.
Thank you. Thank you.
Any other questions?
No, thank you.
Excellent. Thank you for your report, Mr. Kryman. Moving on to the Chief Investment Officer report, Mr. Grable.
Good morning, Madam Chair, trustees. Welcome to Mr. Rue, our newest trustee. I will pause and I won't go through my comments. In fact, I could turn my piece of paper over in that I enjoyed the equity committee meeting this morning. I agree with Mr. Kelly's comment about, this is a lot of the infrastructure that we tend not to spend that much time on, but given that, almost half of our assets are benchmarked to that, it's so important. And one thing that I'll maybe pivot from that, in later this year, we'll start our strategic asset allocation exercise. And part of that is using this index in terms of constructing how we apportion assets. And maybe connecting that in turn to our investment beliefs that we updated last year, our old investment beliefs had a blanket statement, we're a global investor. And that's pretty high level, and we are a global investor. We have securities all over the world. What the board did with our new investment beliefs is add nuance to that. That nuance is that from both a return and a risk standpoint, different geographies have different prospects, different transparency, different return profiles, different risks, and some of them were discussed in terms of the ability to transact. And one thing that I would like to do as we go through this strategic asset allocation, different from what we've done in the past, is maybe have more scenario testing, really taking advantage of our more nuanced investment beliefs to figure out what those risk return trade-offs are with different geographies. Because we've always just done it from a blanket standpoint. At the highest level, we're global. You know, I think that we're in a much more, in a world that's just different than what it was a year, 2, 5, 10 years ago. So that's something for all trustees to look forward to as we embark on our strategic asset allocation. So now I'll go back to my notes. And I will thank Krista for driving slides. And if we could turn to slide 4, please. So on slide 4, this slide is a change from last month. Not just the numbers, obviously, but the format is a change. And last month, Mr. Santos was successful in Stump the CIO, where he asked a question about how the commodity markets did. So what we decided to do was recast this slide to show the 2 most important indices on the top, which is the ACWI IMI, which we just had an hour meeting about, and the bond market index. But to it, we added more granularity about equity markets, fixed income markets, commodities, infrastructure, and some other asset categories, just to show how all those different markets performed over short, medium, and longer time periods, recognizing that our portfolio may be driven by what happens in global equity and investment grade fixed income, but there's much more to it. So this slide, and well, like this slide, we continue to refine different aspects of the report over time. And as you can see from the slide, this is the results ending February 28th. And you can see that it was a down month across all major asset categories. And maybe the big story that's reflected in terms of the negative return performance of fixed income is that yields are up. And that may be the biggest story in capital markets and across the portfolio. I think yesterday, after the Fed chair's testimony, the 2-year Treasury crossed 5%. Later this morning, we're hearing from the actuary to present the actuarial valuation for board consideration. If we're trying to get 7% and you can earn 5% in a 2-year note, that really changes everything, potentially.
I think you're correct.
That changes potentially how we asset allocate, what our capital market assumptions are, and the amount of the portfolio that we may need to stretch. When interest rates were 0 and we're trying to get 7%, that means that the non-fixed income assets needed to earn 10+%. Now it's a lot less. So I think that this is going to be a really interesting strategic asset allocation exercise that we go through. And if we could turn to slide 9, please. Slide 9 shows the results for the pension for the fund as of the end of January. We can see on the upper left, it was a very solid month. There's no definition of solid. I mean, 3.5% is materially positive. The market value of the fund was $72.5 billion. As you can see in the middle bottom, cash is at our target. We like to keep at all times about 3 months worth of benefit payments available, part of business continuity planning. And on the right, we could see our actual asset allocation at the functional categories, and all are within policy. But that, once again, that's what we're going to be spending beginning in the middle of this year into next year, really focusing on what that chart looks like going forward. On the next slide, please, Krista. The pension is detailed on the top. And if we can look at the total fund return fiscal year to date through January at 4.1%, which is our return fiscal year to date through January. That is at our actuarial target. It's been a really long time since when we've been able to say that after going through a very challenging calendar 22. We are at or above our actuarial target for the longer time horizons going back, a decade. Once again, this is highly relevant as we have our actuarial discussion later this morning. If you look once again in the fiscal year to date column, you can see that there are positive contributions from multiple functional categories. That's very different than if you look at the 1 year column where real assets, provided, the only boost to returns last year. I don't know if boost in real assets, if that's an energy joke. I know I shouldn't tell jokes, but maybe that is one. OPEB on the bottom finished January at $2.8 billion. That is a high watermark. There may be some trustees here who remember when we didn't necessarily have an OPEB trust or when it was sub $1 billion. $2.8 billion, that's even more material than it was in times past. So I think that's something that, once again, as we do our strategic asset allocation exercise and as we implement private assets for that, it becomes that much more a focus of ours. As we can see in the chart, OPEB, given that there are more public assets, was up 5.7% for the month and at 6.8% fiscal year to date. Note that 6.8% is above the OPEB actuarial target of 6%. So if we can turn to slide 12.
Quick question, Madam Chair.
Yes.
So the OPEB, so the 2.8 billion, you said, out of that amount, what is has been contributed in terms of returns, and what amount, if you have it, does the county contribution reflects county contribution?
We can work to get the answer by the end of either this report or the end of the meeting, if that's helpful. So on slide 12, yesterday the chair and I discussed private equity. So I'll provide an answer in the context of this slide, given that private equity, the allocations referenced at 17.3% actual weight. If you look on the chart on the right, where it says percent weight under growth, private equity is over 17% of fund assets. What this chart shows is total fund forecast risk as measured by prospective volatility. And just drawing a connection to the presentation we had in the equity committee, we use as our fund risk provider another unit or other software from MSCI. So in addition to benchmarks, we use their risk platform that gives us security level risk analysis. Later this morning in reports, John and Tara will go into more detail about total fund risk and performance as well. So as we can see with private equity, the weight is 17.3% of the fund, and the volatility, the contribution to total fund risk is almost double that. So private equity per dollar invested has among the highest risk in the portfolio. As you know, a reminder, private equity valuations are lagged by 3 months. So as a consequence, our total fund performance book, be it returns, be it risk, really are a mixture of different time periods. And future private equity marks, valuations, performance really depends upon the direction of current and future public equity markets. And a potential markdown in private equity really is dependent upon the direction and the duration of a potential market downturn, such that we've been in periods where there've been quick snapbacks in private equity, which is lagged in valuation, has really had a steady state or upward trajectory just because the duration of a downturn has been pretty quick. As I mentioned on, I think it was slide 4, that as interest rates rise, that certainly will have an impact on private equity, because private equity is levered equity and is dependent upon capital, cheap capital to finance companies. So that will change what happens to private equity and every other private asset category. The absence of cheap capital is wildly important. So a couple of thoughts are: one, we have a mature private equity program that has had strong historical returns. Those returns are detailed in our quarterly performance book. And part of that is that we've invested through cycles. Our 10-year annualized return is north of 17% per year. 1 year, it was up about 5% versus, a loss of 19% for private markets. And I think that, and I don't want to speak for the chair, but that may have been the comment about in our conversation about private equity benefits from kind of attractive accounting conventions, that there's that potentially benefits investors like us in terms of the accounting that's done 4 times a year as opposed to effectively daily. As this slide shows, private equity has higher risk contribution. So that's one way it's represented, the higher actual, not the accounting, but the higher actual volatility and potential risk associated with private equity. This is included in our structure review. The board approved a structure review in December, I believe, for the growth asset category, including private equity. So that contemplated how we implement this portfolio, recognizing illiquidity leverage and higher interest rates. A couple points about the 17% and where that number is, that allocation, it has increased over time. It's our target 17%. In 2021, for some of the newer trustees, it was 10% target, but our actual was much higher. Our actual is closer to 14% at that time because of strong returns, that it kept on going up because it was outperforming. However, that growth from 10 to 17% is offset by the reduction in global equity. So 5 years or so ago, our global equity allocation was about 12% higher. So there's been kind of an offset to private equity from public equity, given that private equity in many ways is our most active form and implementation of our equity allocation. We currently have about $4 billion of undrawn commitments. That's factored into our pacing models that are part of the board structure review. Lots of moving parts in terms of not just risk, but what happens with the LACERA numerator, the denominator, and the pace of call downs and the return of capital. And that I know is also reflected in the CIO report in terms of rebalancing, because capital calls and return of capital are reflected there. But once again, everything we do across all these asset categories and the risks and the risk contribution, standalone and collectively, is reflected in our asset allocation and our structure reviews. And if we could turn to slide 18.
Madam Chair, I have a question.
Yep, and I also have a comment before you leave that. Go ahead, Mr. Jones.
Okay, so question for you. In the higher for longer interest rate environment that we're kind of anticipating, do you have a period of time where we've had our private equity program where we've had a similar condition? I know we've invested through cycles, various kind of economic cycles, but I don't know that we've had an economic cycle that has included a higher for longer threshold. Can you, if we have done it before, can you tell us what we should anticipate as trustees in terms of that category? And secondly, what if we haven't had it, what do you anticipate may happen with that category? Just from a board awareness perspective.
So question about higher for longer, what happens with private equity? LACERA'S invested in private equity since the mid-80s. So we've been through cycles now. No one on the investment team was working on private equity in the mid-80s at LACERA. So I don't want to say we're going back to the playbook. Personally, I was a private equity executive in different periods. I've been through cycles myself, so I've seen firsthand what happens as interest rates rise, as exit markets close, as transactions cease. I think what tends to happen is transaction volumes slow down, funds hold on to capital for longer rather than coming back and raising capital every couple of years. Having access to capital potentially is a strategic advantage for funds as transaction volumes slow, especially in growthier areas for companies that may not be cash flow positive. So I think potentially there's a greater dispersion of outcomes, which is potentially positive for someone like LACERA, who I think has a fantastic private equity program. But as it relates to interest rates, with a rising cost of capital, that makes private equity harder, but it makes all private assets harder. So I think that that's something that we must contemplate as we do our next strategic asset allocation, and we look at what the prospects are for private equity and other private assets that are dependent upon a low cost of capital, because there's more competition for our capital, and we should never take uncompensated risks. And if we can get 5% for no risk, why do we want to lock up potentially capital, for longer? But once again, I don't know what the models are going to tell us, but I think that we have to apply judgment to the science.
I appreciate that, because I'm seeing the same debates play out publicly amongst all the analysts about it, and that having, parking your cash even at 5% in anticipation of an environment where you can get the same private assets much cheaper through there, is a tactic. And I'm just curious in terms of how you were seeing it, from that perspective.
And Madam Chair, if I can add one thing, which is when we do a strategic asset allocation, we don't do it just for tomorrow. We do it, based upon 10-year capital market assumptions, and then look at how those market assumptions may change over a 20-year period. And so we're investing for long time periods, and the 5-year may be attractive today, but we really need to always do this in the context of longer time frames.
Great. I have a comment, but Mr. Knox, I saw your hand up and then come down. Did your question get answered, or are you still itching?
Yes, Madam Chair. Mr. Jones made an eloquent request of information. It covered me. Thank you.
Got it. Okay, thank you. So the question that I have, Mr. Grable, is regarding the pacing model. You mentioned $4 billion of uncalled capital, which will be taking advantage of a far more attractive vintage set of opportunities. However, how much capital would you say was deployed over what was effectively the height of the market, which is, really during the pandemic? I think is about when we reached the peak valuations just before the invasion of Ukraine. And so Can you tell us a little bit about sort of how much of our capital is at risk to that very overvalued segment, vintage set of investments, and what was our approach in order to ensure pricing discipline during that time period?
Yes, and I don't want to affirm that our capital was not deployed prudently and is
Yeah,
in
that's not what
overpriced
I'm getting at.
investments.
Yeah, I understand.
When the board approved the last strategic asset allocation in 2021, and the first step was in October of 2021, our target allocation to private equity was about 14%, and our actual was about 14%. The denominator was a little different then; it was lower, or it was actually maybe similar. The denominator has moved up and down over the last 3 years, and our actual is now 17%. I don't have what our fund balance was, and once again, somebody could get me the numbers. I can do a quick math, but I don't think it's gone from 14 to 17%, not knowing what the actual denominator was in all time periods. So I think
I
it's
wonder if you
somewhat
can
measured.
study that and take
Yep.
it away as something to report back at our next meeting,
Yep.
rather than try to wing it right now. But I just wanted to kind of ask the question.
One thing I would add, Madam Chair, is when the board approved the last growth structure review, we did something where we moved from committing an actual dollar amount per year to private equity to a percentage. And it sounds like, so what? Which potentially is a huge adjustment, because that allows us to potentially be more cognizant of the denominator and be more aware of what your point is here.
Right.
But we will get back with an answer. Maybe we'll just do an FYI memo next month for the board.
Super. Thank you so much. Mr. Santos?
Yeah, I just want to make a comment that in 2008, when we had the Great Recession, there were some mistakes that were made at the time in that we decided to go into a moratorium in terms of private equity. And that turned out to be the worst decision, in my view, that we ever made. One of the things that I mentioned to Mr. Grable at the beginning of the pandemic is that I want to make sure that we would not make the same mistake that we made in 2008, 2009, and that prudently, we will need to continue to invest, notwithstanding the pandemic. So that is something that has been very keen in my mind, to make sure that whatever comes to us, we will continue to follow asset allocation and the great work that the staff and the consultants do.
Thank you, Mr. Santos. And I will take the chair's prerogative and have the last comment, which is to say that none of my comments actually would have gone against anything that you are saying. I was just asking to understand the pacing, because cycles are cycles, and inevitably we will deploy capital in a highly valued environment, but we do have dry powder to take opportunities, of excellent opportunities, which is your point, that when crisis hits, it is often a very interesting. Some of the best vintages performance occurred in vintage 09, 2010, 2011, which was after the crisis, which was precisely when the moratorium would have been in effect. And so to miss out on that would have been highly negative. And I think that we are positioned to take advantage of that. But it is important to be cognizant and learn from the pricing discipline that occurred during the valuation cycle to see how exposed we are to higher valuations. I think that's a prudent thing to do as an organization. So with that, I'll
Madam
give it
Chair?
back to Mr. Yes,
I just wanted to add one more page, if that's okay.
sure.
And slide 18, please. This slide details different structural aspects of our program. Rebalancing is on the left. Overlays and hedges are on the top right. You can see on the top right, January was a positive month for our currency hedge and our cash overlay. January, the currency hedge generated $52 million, the overlay $90 million. And if you look at inception to date gains, 1.4 billion and 314 million are very material numbers. We talk a lot about manager alpha. I would say that maybe this chart in the top right is LACERA alpha, just by focusing on structures and how we operate and operations. If right now, if our balance is 70 billion and you strip out, $1.7 billion from that, that's material. And that would have an impact on what the actuaries would say later this morning. So I think that how we design our programs really is important. The bottom right, there's an update on current RFPs. And I'll highlight that Mr. Jones several months ago asked about tracking responses to our real estate and real assets emerging manager program search. There has been keen interest. We have received 18 responses. And to put that into perspective, private equity, when we did that search a couple of years ago, had 16 responses, but illiquid credit, hedge funds, and global equity all received fewer than 10 responses. So I think that I don't know the quality of the responses, but there was concerted effort to get word out, and 18 responses was above my expectations. So I think that that positions us well to evaluate potential emerging manager program advisors for the fund. And Madam Chair, with that, I'm happy to stand for other questions.
Super. Any other questions? Thank you for that, Mr. Grable.
Madam Chair?
Yes.
Yeah, I will make one more comment. I mean, I think per the article that I think Herman sent out to us 2 or 3 months ago, I do, just as a general comment, that the private equity portion of our kind of supervisory roles, trustees, is the one most likely to get the highest level of scrutiny through there. So I think it's important that we have the larger conversation and kind of restate on the public record kind of our approach and our sense of awareness of not only the promised when all things are great, but kind of things that we may anticipate as things potentially go sideways through there. So I just wanted to
thank you.
Really noted.
Thank you, Mr. Jones. Mrs. Jones?
Good morning.
Good morning.
I too like the change that you made on page 4 with the indexes. So that's very helpful. Thank you. And thank you for the detailed response on page 12. Because I had spoke with you earlier, I had questions and you further clarified even this morning. So thank you. The only thing I wanted to ask about, because these are my favorites, is the staff chart of the month. And so I think this coincided coincidentally with the presentation we had this morning as we were talking about China and how, they were still an emerging market, but it seemed like they were the leader in that area. And so I was just curious to see what staff's thoughts are in relationship to this chart and why is now in 2022, China's economy, why does it look so strong now versus the prior year?
Yeah, part of obviously China's economy has grown tremendously over those 2 decades referenced here. A lot of people moving from farms to cities, a lot of government debt financed growth. By many measures, China's economy may be larger than the US economy. By some measures, China may invest more in startups and technology than the United States. I don't necessarily want to opine on all the actual figures that come out of China. I think that I think all numbers, all data, you have to look at the sources. But I think you can triangulate, and it's unimpeachable, the fact that China has grown tremendously. As it relates to investability, the growth of an economy doesn't necessarily translate or correlate 100% with the performance of capital markets. So a lot can be growth in government sectors. And what was discussed by MSCI is in terms of the ownership. And so there's a lot on here, and there's a lot that's not on here. And I know that we have for the offsite questionnaire that's going to be going out to the board, hopefully next week, there is an opportunity to further delve into geopolitical matters such as China and the interplay. But China certainly has grown. Capital markets are different there than they were, or now than then. But beyond that, I don't know if I'm necessarily answering the question.
You did. Thank you. And I just wanted to share that I like the idea that you presented as we move forward and we start talking about global markets. And like you were saying, where we may say, well, we invest internationally, but maybe we can start looking at specific areas that we may want to focus in moving forward. So I welcome that conversation.
Like Latin America.
Thank you. Excellent. Thank you. Thank you for your comments, Mrs. Jones. Ms. Jones. So I also want to make one last comment, which is your last slide that you presented. I think you are spot on in representing hedging and the overlay, the cash and overlays on the program and the structure of our program as LACERA Alpha. This is absolutely what asset allocation is about. And so I am just very pleased to see that the efforts that we do and that you and your team make in order to ensure that we have an appropriate structure, an appropriate rebalancing process, and thoughtful hedging and overlays, that those are actually contributing materially to the outcome of the portfolio. So I think that is directly kudos to you and your team, John. Thank you. So with that, and hearing no other questions, we will move on to our consent agenda. So we have, go ahead.
Oh, go ahead.
I'll move the consent item.
I'll
Thank
second
you.
that. David.
Okay. Linda, can you take the roll,
Miss-
please?
Mr. Knox,
Aye.
Mr. David Green,
Aye.
Mr. Santos.
Yes.
Mr. Jason Green,
Aye.
Mr. Rue,
Yes.
Mr. Jones,
Aye.
Mrs. Jones. Aye. Mr. Kelly
Yes.
and Ms. Sanchez.
Yes.
The motion passes unanimously.
Super, thank you. Moving on to the non-consent items. We have three. Our first item is our actuarial valuation of retirement benefits. With that, I will turn this over to who will be leading this presentation?
Head Granger.
Mr. Granger. So Mr. Granger, can you go ahead and kick us off into the conversation and invite Milliman to present?
Absolutely. Thank you, Chair Sanchez. Good morning, Board of Investment Trustees. My name is Ted Granger. I'm with LACERA'S Financial and Accounting Services Division. With us here today in person, Milliman, LACERA'S consulting actuaries from Milliman. To my left is Nick Collier, and to his left is Craig Glide. Also joining us virtually today is Brent Bannister from Kavanaugh McDonald Consulting. He's LACERA'S reviewing actuary. So I have just a couple of comments. And I want to thank Krista for driving the slides today. She can go ahead and pull those up, please. We're here today to present the results of the 2022 actuarial evaluation. And there is a recommendation before the board. We're seeking approval of the valuation report. Within that report, it includes updates to the employer contribution rates as well as the member contribution rates. And this is for all plan tiers. Nick will talk a little bit more about that in his presentation. And well, once we receive approval, we will go to the Board of Supervisors with this report and we will ask them to approve the contribution rates so they can be implemented beginning July 1, 2023. In addition to this, our plan will include communication to the LACERA members as well as the LACERA stakeholders so that they can become aware that the contribution rates will be changing, primarily increasing for most, if not all members. And finally, in the report or in the package, we had 4 reports today, and I just wanted to touch base on those. We did have the actual evaluation. We had Kavanaugh's review of that report. We also provided the experience study, which was a draft report back in December, and the experience study review. So those reports have been finalized. So that's why there are so many reports in the package today. And with that, also one other note was that this really concludes, this report would conclude our 2022 triennial year where we do the experience study every 3 years and then we prepare the valuation. So we're pleased to be at this point, and unless there's any questions for me, I'm going to hand it over to Milliman to start kick us off with the slideshow.
Thank you, Mr. Granger.
Good morning. It's good to see so many people in 3D today after so many virtual meetings. So it's good to be here. As Ted said, we're going to be talking about our June 30, 2022 actual evaluation of retirement benefits.
Krista's driving the slide.
Oh, sorry. Please move forward. Thank you. So looking at, I'm just going to do a quick overview of the valuation results, and then Craig is going to kind of provide some details behind that. Short story is the message we're going to have is very similar to what we told you about when we estimated the results back in December when we presented the experience study. First off, looking at the investment return, as always, that has a significant impact on your results. If you look very closely, you can probably see that there was a 0.2% return on a market basis, and that's on a money weighted measurement. So that actually was quite a bit better than most retirement systems. But as Mr. Grable talked about, that our target is 7%, so it falls well short of our 7% target, which obviously has a negative impact. But as you remember, we smooth our actual value of assets that we use in calculating the contribution rates to avoid unnecessary contribution rate volatility. And since we're still reflecting that great return from the fiscal year into 2021, when we roll all that through the smoothing process, we actually end up with an actual return that is north of 7%. So once we take that, the investment return, and combine it with the demographic experience, as well as the assumptions and method changes that were adopted back in December, you see that the employer contribution rate went up from 24.46 to 25.84%. Similarly, member contribution rates went up. Those range from basically no change to up to about 0.4% of salary. That varied obviously by plan and by entry age. Next, looking at the valuation in assets, as noted, the valuation assets, we smooth the investment gains and losses relative to that 7% target. The accrued liability, both of those, really the year-to-year experience was kind of in line what we typically expect. And when you kind of roll that through to calculating the funded ratio, that is how much assets we have in relationship to that accrued liability, you see we had a small increase from 79.3% to 79.6%. So with that, I will turn it over to Craig. If we can move to the next slide.
Okay, thank you, Nick. So as Nick mentioned, I'm going to dive a little deeper into some of the results of the valuation, primarily focusing on the funded ratio and the employer and employee contribution rates. I'll give you a little bit more detail on those and discuss some of the reasons and some of the changes since the prior valuation. I'll also look at some of the individual plans a little bit more specifically. But starting off on this page here, we're looking at aggregate results for the system as a whole. And on the chart on the left, starting off with the two bars called AAL, that's the actuarial accrued liability. And just as a refresher, the actuarial accrued liability is the liability that's attributed to all past service benefits that have been earned. So all retired benefits, retired member, former member benefits are included there, as well as any past benefits that have been earned by active members for past service. And so over the year from 2021 to 2022, the AAL increased by about $4.4 billion to $86.3 billion. LACERA also pre-funds their benefits, and so you know a lot about the assets, and so there is an asset pool here to fund those liabilities. And over the year, the valuation assets increased by about $3.8 billion. So the liability increased about 0.6 billion more than the assets did. And because of that, that 0.6 billion moves into it shows up in the unfunded liability value. So the increase there from 17 billion to 17.6 billion dollars over the year. Now, even though the excuse me, even though the unfunded liability did increase by that $600 million, because that increase was relatively small compared to the increases in the liability and the assets, the funded ratio did increase a little bit from 79.3 to 79.6% over the year.
We do have one question, Mr. Santos. Do you want to ask now or at the end?
Yeah, so how much or what percentage of the unfunded liability was increased by removing the star COLA from the valuation assets?
So the star COLA, when those were removed from the assets, that was about $600 million. And so that would have increased the unfunded liability. I think it was 0.5%, or the funded ratio, sorry, dropped by about 0.5%.
And as a consequence, the employer contribution was increased as well as the employee contribution was increased. Would that be true?
Only the employer contribution, because the members don't contribute to the unfunded liability.
To star COLA. Okay, thank you.
So looking at the employer contribution rate chart on the slide here, if you recall, the employer contribution rate is made up of two components. There's the normal cost component, which is the cost for benefits that are being earned by employees. And so that's the blue bars on this chart. And then there's the second component, which is to fund the unfunded liability, which the employer funds entirely. And so over the year, both of those pieces did increase. And so the total employer contribution rate increased from 24.46% for the fiscal year beginning in 22 to 25.84% for the fiscal year beginning in 23. Additionally, the members do contribute to the cost of their benefits, and that's shown here in the green line. And so from year to year, the aggregate member contribution rate increased from 7.87% of payroll to 8.21% of payroll. And I'll talk about some of the impacts on the specific plans in a little bit. Next slide,
And
please.
I have one question before you leave that slide, actually. Has Milliman calculated a sort of performance hurdle that would be required to catch up that unfunded liability? Or if you haven't, I would welcome a calculation and a report back at some point.
We do a couple calculations. One is kind of internal. It's like, if the employer kept contributing at the same rate, how long would it take to pay off that unfunded liability? That would be about 17 years. Now the rates are going to change because they do flex, but that kind of gives us an idea of kind of what our kind of target is. Second thing we look at is from year to year, do we expect the unfunded liability to grow or to decrease? And right now it's really, as you see, it went up a little bit this year, and that was kind of related to some of the primarily the Star Cola, as you see, that was about $600 million. So right now we'd expect things to stay pretty level. But as we go forward the next few years, we expect that to decline if based on the assumptions, of course.
Yep. Okay. Thank you. I think at some point it would be an interesting calculation to calculate sort of the break even performance required to see kind of how reasonable or unreasonable that is. Just something to think about.
Yeah, so you were looking for maybe a couple of measurements like how
Like
much
what kind of return would we have to
Okay,
make over the
exactly.
next, exactly. Thank you.
And by
Moving
when
on.
we will, and by when we will reach 100% funding, which is kind of the same, right?
Those are two moving parts though, because you're going to have to make an assumption about the horizon to calculate the return. So one of those has to be a fixed assumption. But I'll leave it to Milliman to think about how to do that eloquently.
And the unfunded liability is amortized over a 20-year period. So I mean, if we just earned the 7% valuation assumption every year and we didn't have any other gains and losses, that would be
that's where we would be.
That's basically it's that 20 years is when all those layers would be paid off through the amortization.
Thank you.
Quick question.
Yes.
In relationship to that, and I do see you do have a chart for the funded on page 3 of your report. But I guess my question is there a delay? So if we're looking at our funded status today, is that from numbers from 2 years ago, or is it numbers from investment turns last year, or what's the timing?
All the numbers we're showing you here today are as of the June 30th, 2022 valuation.
Okay.
So we're valuing assets at that date.
Okay.
With the one caveat is that we smooth gains and losses, so we haven't recognized all of them. You're in a position right now where the gains and losses have almost exactly offset. So it's, last year we had these great returns. We thought we were kind of deferring some good news, but right now we're kind of neither deferring good news or bad news.
Next slide,
Thank
please.
you.
We may have stolen some of my thunder from this slide and some of our conversations there, so I'll try and keep these comments short. So as we talked about, the funded ratio increased about 0.3% over the year. There were various reasons for that change. And some of them were offsetting. So this chart sort of summarizes what those main reasons were. And when you look at this chart, the green bars generally reflect good things, good outcomes. So in the context of the funding ratio, these are items that cause the funding ratio to increase, and red bars are items that cause the funding ratio to decrease. So first of all, is the expected change in the funded ratio because of the unfunded liability contributions that are being made through the amortization method. So we did expect an increase in the funded ratio by 0.9% because of those contributions. Secondly, on the assumptions and methods that the board adopted, I think at the January board meeting, those caused a decrease of 1.4% in the funded ratio. And that's kind of right in line with what we presented at the experience study with what we expected that change to be there. When it comes to the asset gains that are being recognized in the valuation method, we've broken that out into two pieces here. For prior year asset gains being recognized and current year asset losses being recognized. And so what's happening here is that in 2021, primarily because of the strong investment performance relative to assumptions in the year 2020 to 2021, there were deferred investment gains that hadn't yet been recognized in the valuation assets. And in 2022, those were largely recognized. And so when those got recognized, that caused an increase in the funded ratio of 2.6%. Conversely, in the 21 to 22 year, Nick mentioned the asset performance was about 0.2%, less than the 7% assumption. So we had asset losses. And so as we recognized those into the valuation assets, that caused a decrease of 1.5%. So a net increase when we looked at all investment gains of about 1.1%. Other items were much smaller impacts. The more significant one on the bottom here remaining is the impact that inflation had on the retiree COLAs. and on the retiree COLA banks, with the COLAs being higher than assumed. The retiree COLAs, especially for Plan A retirees, were higher than assumed. And then going forward, because there's larger COLA banks, we anticipate slightly higher COLAs there. And that item is just commenting on the regular COLAs, not the star COLAs. So because the star COLAs are only star COLAs that have already been granted are included in these numbers. Any future star COLAs are not included there.
Great. We have a question for Mr. Jones.
Yes. Yeah, so question for you then around the funded ratio, where we are 79.3 to 79.6. And that assumes a 20-year, if everything kind of stays fixed, then we kind of get up to 100%. So how should we feel as a board about where we are? So based on all the plans that you see, is 100% a holy grail, is probably always mythically being chased after. But is 90, puts you in the 95th percentile? Does 80, how should we look at this as a performance standard, and then kind of feel about it relative to how others are doing on the funded status?
For me, and Craig can add, I think what I look at is how we're progressing in the future. Are we making progress towards 100% funded? What is that relative progress? Obviously, you could have a plan that was 70% funded that in some respects could be better than the plan that was 90% funded if they're not receiving the contributions. Obviously, you're receiving your contributions. And I think Ms. Sanchez's comments about having some sort of performance metric to kind of show how you're making that progress would be useful. We do have in our supplemental slides, we just did a comparison with other California counties. Now, California tends to have, because they have better actuaries and California tends to be better. California retirement systems have been more responsible in funding their plan, and their plan sponsors have been more responsible in funding their plans. So they tend to be better than national. So I'm just talking in California, the average, looking at the big systems and all the 37 Act systems, the average is about 82%, and you're just under 80%. So you're right kind of in the middle of the pack. So we're definitely not concerned where you're at. Obviously, we'd like to see you have a higher funded ratio, but you're making progress each year, as you saw, even with the assumption and methods that you strengthen things, even with that and the poor return from last year, your funded ratio still increased. So we feel pretty good about where you're at. I don't know if you want to add anything.
Nope, you covered it there.
Thank you.
Madam Chair,
Mr. Kelly?
thank you. I wanted to just comment on Mr. Jones's question. When the county goes to pitch its credit rating to the credit rating agency, the conversation isn't focused so much on a specific number or return. It's really the story of the plan sponsor's commitment to the retirement agency. So for example, the bullet point in that slide deck that says the county has a 20+ year of meeting its annual obligations to the retirement agency in a timely manner. That's a really big deal that not every other county can say. So, and it constitutes kind of a narrative about how the plan sponsor is taking seriously the financial obligations and the management of the assets, et cetera. So it tends to be more of a story rather than a focus on a specific number for a specific year. I just wanted to comment.
Thank you, Mr. Kelly. That is a very good point. Ms. Jones?
And I just wanted to, sorry, thank you. I just wanted to add to Chair Sanchez's request when she had asked at looking at an analysis and with various scenarios of what it would take to get to the 100% funding. And you mentioned, if our member contribution rates stay the same, it take about 17 years. And I think the importance of identifying that today in 2023 is if 10 years down the road that extends out and now it's, another 5 or 10 years added on, then there may need to be a decision of, do we want to bump up that because we keep pushing, we keep kicking the can down. So I think it's important if we could look at that today, just so we memorialize today, this is where we think we'll be. And then we can look at that, you know, years down the road and say, okay, we should have been here by now, whether we are or not. Are we tracking? Are we ahead of schedule? Because, you know, I do look at your document, you know, back in 2002, you know, we were fully funded. So it was a great time. And, you know, I think the importance of making sure that we're progressing towards, you know, 100% as much as possible, with making the right progress. I think, you know, in the 1 year you said it went up just a small percentage. And is that okay? Is that what we should expect to get us to, you know, being fully funded within the time period that the board may feel is reasonable? So just wanted to add to your request, Chair Sanchez.
Yeah, I note that in the prior experience study, we talked a lot about the amortization policy, the policy to pay off the unfunded. And I think the board made some good changes that strengthened our progress. And we did, you know, a lot of analysis under different scenarios of how things would react. And we think what you have right now is a pretty good policy that balances paying the unfunded off, getting to 100% without putting undue weight on the plan sponsors. You know, it's always going to be trade-offs. That might be something we want to look at 3 years from the experience, you know, if you, or we could maybe look at that if we do another risk assessment. So.
Thank you.
And
Thank you.
If I could just add real quick. So one of the things we did, and Nick's referring to, is go from the 30-year amortization to the 20-year amortization. So that would be to shorten that time frame a little bit. And I think another thing to add sort of globally to this process is that we have a valuation performed annually. So we're constantly, in my mind at least, measuring where we're at and where we need to go. And if, I think I've said this before at these meetings, but if Milliman sees something that we're doing or not doing that needs to be adjusted at our annual val, they don't wait until the experience study is done. They'll come back to us and say, hey guys, guess what? We need to take a look at this. This is out of whack and we need to fix that. So.
Great. Thank you, Mr. Granger. That is excellent to hear. Mr. Santos.
Yeah, I just wanted to say that in 2000, when we were 100% funded, our discount rate was about 8%. So we have to be conscious of that. And I believe in 2008, in 2001, the recommendation by Milliman was that we needed to reduce it. And so it's been very painful. But this board has met the challenge to keep our expectations, return expectations in line with what the capital market is dictating. So that also has to deal with that. And it's something in my mind that we always need to keep on top of, is to make sure that the discount rate reflects the markets, because a lot of those funds in other parts of the country are way higher than ours, which is problematic in my view. One of the things that at the beginning of this discussion from the very beginning is, do we need to change that 7% discount rate? Because I want to make sure that when I retire being selfless, that we will have the money there. But that's the way we have to look at it. So anyway, just want to say that.
Thank you, Mr. Santos. And that's an excellent point, and one that obviously I have shared with you over the years. Mr. Green.
Thanks, Madam Chair. I'm just looking for a point of clarification. The unfunded liability, is there an assumption in the analysis and that everybody would retire at the same time? Is that creating that liability?
There's not there's based on when we do the triennial experience study, we do review when people are retiring, and so there is a table of rates based on age and whether a member's safety or general. So there's a table of probabilities of when a member will retire. So it's not just one single age. The unfunded liability generally has occurred because over time, actual experience hasn't fully matched the assumptions. And so the investment return tends to be the largest contributor to that. But definitely when people, because generally the one thing we know about our assumptions is that we won't meet them exactly. There will be some deviation. And so over time, if people have retired at different rates, that will either cause an additional unfunded or negative unfunded, if you will. But every 3 years, when we look at that each time, we're kind of looking at the more recent experience to true up those assumptions if we feel like they need to be trued up. And so hopefully we're we're using the history that we have there, and that they'll more closely match what we're expecting to see in future years.
Gotcha. And then the last question, is there a threshold that poses great risk of future? What is the, if that, do you have a threshold for that? What's the low ball? Liability.
Do you mean sort of with regard to the sort of funded ratio
Right,
level?
yeah.
Yeah. I mean, I think as Nick mentioned, I mean, one of the main things we're looking at is that there's progress being made to eliminate the unfunded, and that the assumptions are reasonable and the fund level of funding is reasonable to get the retirement system to 100% in a reasonable period of time. And so, and depending on the assumptions, if we were using a higher discount rate, say an 8% or 9%, the funded ratio would look better, but it wouldn't necessarily mean that the system was in a stronger financial position. So I think where LACERA is at around 80%, and with the strong funding that has happened and is anticipated to happen, and the assumptions that are set, I think we feel that LACERA is fine, but I'm not sure that there's one specific threshold I would say means it's bad, because a lot depends on the assumptions and the commitment to funding it.
Thank you.
Thank you for that. And I just want to underscore everything that was just said. It is a delicate balance between evaluating what is an appropriate discount rate. And as Mr. Santos mentioned, we have been very prudent about adjusting that as the capital markets dictate. And in making those changes, we also effectively adjust how much employees have to contribute and how much the county has to contribute as a result of those. And so there is a burden that's shared on the investment team to produce the results, but also on the plan sponsor and on the employees themselves to sort of prudently save for the retirement, for the estimated life expectancy they're expected to have. So it is a lot of moving parts. And I just want to say that I think we're doing a very good job. I'll hand it back over to Milliman to continue.
Thank you. Next slide, please. So this is a chart, a lot of the conversation around this chart very similar to the good conversation we just had on the reasons for changes in the funded ratio. These are the changes as it relates to the employer contribution rate. Very similar story here. A lot of the line items are the same. The green bars, again, are generally mean good outcomes. So in this context, it's a decrease in the employer contribution rate. The red bars would mean less good outcomes or an increase. Overall, in aggregate, the employer contribution rate increased about 1.38% of pay. And very coincidentally, you see here that the new assumptions and methods actually caused a 1.38% of pay increase. But that is very coincidental. I don't want to repeat all the stuff we said, but I mean, the impacts we saw in the investment gain on funded ratio, you see a similar thing happening here with the impact on the contribution rate. The one line item I will point out here or draw a bit more attention to, because wasn't on the funded ratio chart, is in the middle of the chart, the payroll increased less than assumed, which caused an increase of about 0.5% of pay. So what's happening there is that in the assumption, in the valuation, we have an assumption that payroll is going to grow by 3.25% each year. But in the most recent year ending in June 2022, payroll actually decreased over that time. So we expected the increase, we did not receive that. And because the unfunded liability contribution rate is expressed as a percentage of pay, when the payroll decreases, it takes a higher percentage of payroll to fund the same unfunded liability dollars. And so that decrease in the payroll essentially caused that 0.5% increase because of the impact on the unfunded liability rate.
Ms. Jones?
Thank you, Madam Chair. I did have a question about that, because, I do know, although there are salary increases being given, I think what everybody is experiencing is we have all these salary savings because it's hard to fill all the vacancies that are going on. But my question, I know, for example, CalPERS, they've transitioned their UAL payment to the unfunded liability payment to a flat payment. So is that anything being considered? Because you're right, the percentage could cause where, you know, if payroll is down for any particular reason, and I don't know how long it's going to take for the shift to come back where, you know, we're fully staffed. Do we have, you know, we're back at our, you know, 90% staff levels. Not sure how long it's going to take to get there. So I don't know, is that a consideration? Is there a trigger that says, you know, maybe we should switch from percentage to a flat amount?
I mean, one thing we do is we look historically at payroll increases. So if, you know, if you've been flat for the last 10 years, you know, we have a lot of concern. You know, there's some cities or other states that maybe they're contracting in their population, and that's a concern. I work with CalSTRS, and there's concern that, you know, if there's more charter schools or whatever, that they might have a smaller teacher population and your payroll decrease. And that would be a good instance where going to what you're talking about, level pay, where you have a flat, level dollar, where you just have a flat payment would be appropriate. If the one thing about level dollar that is attractive to actuaries is that you have to pay a little more upfront. If your pay increases, then your actual percentage of pay decreases. It's the opposite of what Craig just talked about, where our pay didn't increase and we expected it to increase. So it is a more conservative approach. It's not very common right now, but we've got it on our radar. But we have so many things that we talked about with the experience study, and you know, we're pretty comfortable where you're at right now, but we'll keep that in the back of our mind now.
Thank you.
Okay, next slide, please. Okay, so in looking at the employer contribution rates that will be effective for the fiscal year beginning in 2023, we've talked about the aggregate contribution rate at about 25.84%. But as you know, the employer contribution rates vary by the individual plans. And so the aggregate rate is really just the function of what's happening in all the individual plans. And so in this chart, I just wanted to give a bit more detail on what is happening with those individual plans. So starting on the right-hand side, to begin with, this is showing the relative estimated employer contribution for the fiscal year beginning in 2023. The one thing to really note here is that general plans A, B, and C and safety plan A, at this point, they have very, very few active members remaining in those plans. So there's not a lot of contributions being made there on behalf of those employees. For the general members, they're participating in plans D, E, and G. And on the safety side, the vast majority of members are in plans B and C. So just focusing on those plans, when we look at the changes since last year, I mean, you can see that in general plans D through G, the change, it varies a little bit by plan that members participate in, but the increase ranges for general plan G members from about 1.3% of pay to about 1.44% of pay for general plan E. And so that's all the members participating in those plans, the employer contribution rates are going to increase by somewhere in that range. And for safety plans B and C, the increase is it's about the same for those plans. It's about 1.5 to 1.6% of pay is the impact of the employer contribution rates is going to go up for those members. And so we estimated that in aggregate, based on the 2022 population, that was going to aggregate to about 25.84. But obviously, depending on just the sort of the makeup of these plans over the year, that aggregate could move a little bit. Next slide, please.
And just to reiterate, those will be the contribution rates that we're going to approve. Is that correct?
That is correct. The total contribution rates here in the third column are the contribution rates to be approved. Yes.
Thank you.
So similarly, this is the member contribution rates by plan, a little bit more detail on these. As I mentioned, there's all the active members are generally in general plans D, E, and G, and safety plans B and C. General plan E is non-contributory, so you don't see that one on this list. But just when the member contribution rates are going to change slightly for each plan. And on the legacy plans here, which is general D and safety B, if you recall, those member contribution rates are also based on the member's age when they joined LACERA. So members in those plans will pay different rates just based on that age. Whereas for general G and safety C, which are the PEPR plans, the members all pay the same contribution rate regardless of their age at entry. And so looking at the general plans, the sort of range of increases that will be on member rates, and these are again for fiscal year beginning in 2023. And so these are part of the approval package today. The increases for those members from about 0.14% to about 0.27% of pay, which is going to translate roughly to about $10 to $22 a month for members, and for depending on their age at entry and their salary. On the safety plans, the increase is about 0.05% of pay to 0.43% of pay, which gives an approximate range of about $6 to $50 a month for safety members is the additional monthly contribution there.
So, Madam Chair. may I ask
Yes.
a question?
Mhm.
So the $10 up to 22, that is for plan D or G or both?
Oh, so that's for both. Yes, sorry. General plan G, we're estimating is about $10 a month on average. And so then the range for general D would be $12 to $22.
That's the answer.
Yeah.
Okay.
Thank you.
Okay, and next slide, please. And I'll hand over to Nick to talk about the next slide.
Thanks, Craig. When we talked to you back in December, we provided you estimates. We always try to give you the estimates based on the best information we have. Since that was based on the 2021 valuation, we didn't have all the new member information and other things. So as I said, we try to give you the best information and try to avoid any surprises. There was one little area that we were outside of our normal kind of year-to-year variance. So I just wanted to talk about that by comparing the valuation calculations versus the estimates we had from the experience study. And I should note the estimates from the experience study, we did base it on the 2021 valuation, but we did have a few things we knew, like we knew what the return was for the year. So we incorporated that, and we knew what the COLAs were higher than assumed. So we reflected that. And as you can see, in general, we were pretty much right on the information that we estimated for you. So I won't spend a whole lot of time on that, but you can see the funded ratio is 79.7 versus 79.6%. The employer rate was within 0.1%. The member contribution rates tend to be close. The one exception, though, was the safety plan C, which we had estimated at about 14.33%, which is actually at 14.76%, so 0.43% higher. So just wanted to give you a explanation on that, what happened there. So the driver for that was, so for safety plan C, they're subject to the PEPR compensation limits. And that PEPR compensation limit was assumed to go up about 2.75%, which is inflation, actually went up double that, about 5.5%. So how does that translate into a higher member rate? If you remember, the member rates are for PEPR are 1/2 of the normal cost rate. And the normal cost rate is basically the ratio of the value of your benefits versus the value of your compensation. Now, if you look at your current safety plan C members, basically none of them are over that PEPR compensation limit, which I think is about $160,000 right now. But when we do the projections out to close to when they retire, then we have, merit salary increases factored in there. So that salary increase is greater than the Pepper compensation limit. So when we project it out well into the future, a lot of the members are projected to hit that compensation limit. And since it's at the end of their basically their prime retire years when this is happening, kind of 20 years in the future, by increasing that rate more, by increasing the Pepper compensation limit, higher compensation just in those last few years means higher benefits. And it doesn't really affect the compensation too much over their members' career, but it does affect the projected benefits. So that higher Pepper compensation limit raising in theory is good to the members. It's, for the members that hit that compensation limit, because then they get more benefits, but it does translate back into a higher normal cost rate and a higher member rate. And I should note that that was combined with, it was also factored other changes in the membership group from 2021 to 2022, which actually lower than assumed salary increases actually also impacted that. So a bigger change there. But I also want to just highlight that you're likely to see this again next year because the 2023 Pepper compensation limit has been released, and that has a very significant increase also. So you may see another bump up next year. So just wanted to highlight that. I'm going to turn it over to Kavanaugh McDonald, as Ted said, your auditing actuary, and talk about their review of the valuation if there aren't any questions before I go to that.
Okay.
Just a quick comment.
Mr. Santos.
Yeah, just a quick comment. Just ultimate discussion regarding the limit on the PEPRA. It also has a very negative impact on the employer's ability to recruit and retain high-level employees like attorneys, doctors, and administrators. So while I'm not here to speak for the employer, it's certainly is concerning that at some point the county is going to be faced with a very difficult decision with regards to how to deal with those employees on PEPRA.
Yeah, for an average employee, it's the limits, it's up there, but your point is taken exactly for your folks like your doctors and attorneys that out in private sector, they can, make more than that and get benefits based on that. Now, it's not limiting how much they're getting paid, but it's limiting the benefits they're getting on that pay.
Mr. Green.
Thanks, Madam Chair. Yeah, I want to echo that too. In the safety, same thing. There's going to be limitations on that. The safety Pepper limit's going to could potentially impact upper management levels in rank and rank badge personnel. And then the only option will be to replace those with civilian managers. So it could definitely have a long-term impact, like Mr. Santos's point.
Thank you. Do we have any further comments or questions? Okay, we'll hand it over.
Thank you.
Thank you. We can move to the next slide. I'm Brent Bannister. I'm the chief actuary here at Kavanaugh McDonald and oversee the work that we do for you in reviewing what Milliman does. Kind of big picture, what we try to do is go through and just give an independent look at what's going on. We start with the data because if the data is not right, the results are not going to be right. And so we take the raw data and what Milliman ended up with the data. We compare all those. Everything looks good. The data is there. The next thing we do is we actually completely independently determine all the valuation results, all those liability measures you see in the report. We go through the actuarial value of assets, even looking at, this year there was a new method involved there. We kind of check all the calculations that are in there, in particular the contribution rate for members. We independently review that. And then we ask Milliman for some individuals to specific details on them and look at those as well. Kind of behind the scenes that may not be showing up here, we actually change periodically the members on our side who are doing this work, trying to get just, again, another set of fresh eyes looking at this. So we're not just saying, well, we matched last time, we'll match this time. No, we have new people looking at it to make sure that we still think we should match Milliman's results. And we match very well. And that's, like I said, we do our best not to peak. We don't ask Milliman, how did you do this? How did you do that? Anymore than we absolutely have to. We really want it to be a completely independent view. Next slide, please. We then go through the valuation report, compare it to the actuarial standards of practice, and realizing, okay, every consulting firm and actuary within a consulting firm has their own style, and clients have their style. Try to be understanding of that, but do offer some suggestions that we think, in our opinion, and then be only our opinion, might enhance the report for Milliman's view. The next slide really sums it up. Just overall, all the numbers are sound, at a real technical level, but big picture as well. What Milliman is providing you in terms of their recommendations, their calculations, all that. We're comfortable that you're getting good actuarial services from them, and so bottom line, this is good work.
Thank you. Mr. Kelly has a question.
I do. Thank you, Madam Chair. Ted, if you think about our financial auditor, we don't have a team of auditors audit the financial auditors. And I never asked this question before, but what is the history of having this other firm audit the work of Milliman? Is it statutorily required? Is it just a best practice that LACERA'S implemented, or?
Yeah, good question. So I'm going to go back to about 1997, 1998. An issue came up with the actual evaluation at LACERA. And at that point, Milliman was hired to come in and review the calculations, review the data, review the methods, the assumptions, et cetera. And some issues, errors were discovered at that time. So since that time, LACERA has essentially adopted this model of an actuarial, we call it review or audit. We have, I think, increased the frequency of that. Perhaps right now it's about, I believe it used to be every 6 years. So every other triennial cycle, now it's every triennial cycle. In addition to that, unrelated to this discussion, we're talking about pension today, but on the OPEB side, we also have that done as well. So it's a bit of a long history. I want to say over 20 years we've been doing this.
But it is unique to LACERA amongst 37 counties?
I don't think that's the case. I believe other systems in California have adopted this model. I believe that.
I would say pretty much every system has, although maybe every 5 years. I think the GFOA, the Government Finance Officers Association, has a recommendation of an actual audit about every 5 years for certain size plans.
Okay, thank you. And Madam Chair, I'd move the item.
Thank you. So we have a motion to accept the valuation, adopt the contribution, and delegate the authority. And we have a second. All right. Any further comments? Otherwise, Linda, please take the roll call.
Thank you. So I'm sorry, Mr. Kelly made the motion.
Yes.
And then the second,
Jones.
Mr. Jones, 1 second. I'm trying to use our new system. Okay, Mr. Knox,
Aye.
Mr. David Green,
Aye.
Mr. Herman Santos.
Yes.
Mr. Jason Green,
Aye.
Mr. Rue,
Aye.
Mr. Jones,
Aye.
Mrs. Jones.
Aye.
Mr. Kelly,
Yes.
Ms. Sanchez.
Aye.
Okay, the motion passes unanimously.
Great, thank you.
Okay, thank you. So we've been going for about 90 minutes now, so I think it would be prudent to take a break. Can we reconvene at 11 a.m.?
Sure.
Thank you.
Thank you.
Recording stopped.
Let me just grab the trustees 1 second.
Thank you.
Recording in progress.
Okay, thank you. It is 11 a.m. and we'll go ahead and get started again. I realized after the fact that I gave you an extra long break, but it sounds like everybody made good use of it in terms of bonding, eating, and a party in the break room. So we'll go ahead and go to item B on our agenda.
We don't have a quorum, so I just
Okay.
need trustees to
So-
return. 1 second.
Eating continues.
Okay, they're marching back in.
Thank you. Okay, thank you everyone for taking advantage of that break, that long break that I accidentally gave everyone. Okay, we're moving on to item B of section 8. The update of LACERA'S ordinance positions, retirement benefit specialists, retirement benefit specialist 1, 2, and senior disability retirement specialist. And I'm a bit confused because this was actually not included in our agenda preview meeting. And so I wonder, it seems to me like these are BOR positions. So I wonder if you could start by explaining why they're on our agenda.
Good morning. The reason for this being brought before the Board of Investments is that Searle provides that it's a joint responsibility of the Board of Retirement and the Board of Investments to determine the positions necessary to do the work of the boards. So regardless of the fact that these are benefits related positions, it has to be approved by both boards.
Thank you. That is what I needed to know. Okay, continuing.
Right. Right. Thank you. Good morning, Madam Chair. Good morning, trustees. This item before you is to increase the number of positions in the ordinance for the Retirement Benefit Specialist 1, Retirement Benefit Specialist 2, and Senior Disability Retirement Specialist. These positions are located in member services, benefits, RHC, and disability retirement. This request is to increase the number of the positions in the ordinances only. There is no request for additional funding at this time. And the reason we are making this request is to basically start early. The process of amending the ordinance routinely takes around 6 months. So we would like to be able to start the process to get the number of positions increased in the ordinances early in case that we need to use them during the next fiscal year.
Okay, thank you. Do we have any comments or questions of Mr. Santos?
Yes. Good morning, Dr. Latoya.
Good morning.
Good to see you. So this information, this memo is the information, the detailed information that was brought up at the Board of Retirement in terms of the cost, the impact of the budget. Is that true or no?
Yes, Trustee Sanchez, that's correct.
So that's all the financial information that was discussed at the Board of Retirement.
That's correct. The original memo, which was included in your packet, had incorrect information related to the financial impact. So we corrected that with the supplemental.
Great. I move approval.
Okay, thank you, Mr. Santos.
Second it.
Thank you, Mr. Jones. Mr. Kelly?
Thank you.
Oh.
Thank you. I had a hard time following this. And I think I would appreciate if you would consider that not everyone is familiar with the technical jargon that you use in this memo. I'm more familiar with it probably than other folks, but for example, I was looking for an explanation of why this is important, right? Why are you doing this? So there was no discussion between the interrelationship between the ordinance and the actual positions that you hold, right? Meaning every person that comes into the organization needs to be placed against an ordinance item. And then with the supplemental memo, that made it more confusing to me because there's this whole discussion about, well, we may use some of them at some points in time and we may not, depending on turnover, et cetera. So can we go back to just a basic question, which is every year you come to us with the budget and the most significant component of that budget is people, as in any organization. And the people are placed against ordinance items from a budgetary perspective. So why have you not come to us before if there have not been sufficient ordinance items to fill requested budgeted positions?
Thank you, Trustee Kelly. Fundamentally, this is a flexibility issue. And so historically, we have used you're right, the ordinance is like your position authority and the budget is the funding to support that, that particular position. Not all of the positions in our budget, or not all of the funding that's provided in the budget is based on our anticipated filled positions. So some of the positions that are in our, or some of the positions in our ordinance, or some of the positions that are even authorized in our budget are not actually funded or not funded at 100%. So that's a good distinction. Positions like our retirement benefit specialists have undergo an extensive training period. And so we hire them in classes and train them, very similar to how firefighters and police officers and detention officers, positions like that are trained. As a result, those are funded, or those are hired in at the RBS 1 level. And then after the completion of their training program, they sort of auto promote into the RBS 2 positions. So we don't fund them at the RBS 1 level, we fund them at the RBS 2 level, but we have the flexibility within our ordinance to be able to do that. Unfortunately, the level of what has happened over the last several years is as we've hired folks, we've only been filling the classes based on the number of vacancies we have at the start of the class. Well, a year later, we have additional attrition. In the last couple of years in particular, we've seen higher attrition rates than we have historically seen. As a result, we've sort of always behind the 8 ball. So the idea is that this would allow us the flexibility in the future to have a larger training class than we have vacant positions at the beginning of the year, so that when we promote them in, we don't have the ebbs and flows of service.
But what is the relationship of what you just described to the ordinance?
I'm sorry.
The relationship of what you just described to the ordinance.
So the ordinance allows you the flexibility of having a position to place somebody against. So having some flexibility to have additional bodies to put against the ordinance positions without funding allows us to be able to fill those positions and move forward. We can't put someone in the class without a position to hire them against. So that gives us that flexibility.
So we're on the same page with that. But then my question is, why as part of the annual budget cycle, are you not reconciling the requested positions, the positions you're going to fill against the ordinance positions? Because this would have come up before.
We have historically kept that vacancy level, and so we're trying to correct this with this coming budget, but we didn't want to wait because.
So if you would proceed down a path where every year you reconcile the requested positions in the budget to the ordinance, and then brought before the board not only the budget, but any changes in the ordinance, that could be an option.
The challenge with that is really the timing of getting the Board of Supervisors to approve that.
Mm-hmm. Okay, so you're in essence requesting for some of these positions, if not all, more ordinance items than you have the authority to fill in terms of the board's approval of the budget.
Correct. And we would not fill any positions that were not authorized by the board as part of the budget.
Okay. And then my other question was, I think following up on Mr. Rice's comment at the microphone, the legal authority part of this memo was weak to me. All it talks about is authority in state law to spend a certain percentage of the assets. It doesn't reference the law that Mr. Rice just mentioned. So I thought that could
Mr. Rice?
Yours.
Okay. I now can hear you. I wasn't sure what happened there. Did I miss anything?
No, Mr. Jason Green has his hand up.
Thank you. I saw that. Okay. Mr. Rice, did you respond to Mr. Kelly?
The only response would be concur with his comment, and in future memos, we'll make sure that the legal authority on this issue is beefed up.
Thank you. Mr. Green.
So all those funded ordinance position authorizations, you're requesting for your successive plan, like we talked about at the offsite meeting, basically over hiring, right? To accommodate for the ebbs and flows, as you said, and to plan, basically a succession plan for the future to be able to have that, right? That's the whole purpose of this. Is that correct?
That's correct, Trustee Green.
Okay. That's good. Thank you.
Okay. Do we have a motion?
Yes, we have a motion and a second.
Super. Any further comments? Okay, let's take the roll, please.
Mr. Knox?
Aye.
Mr. David Green?
Aye.
Mr. Santos?
Yes.
Mr. Jason Green?
Aye.
Mr. Rue?
Aye.
Mr. Patrick Jones?
Aye.
Mrs. Jones?
Aye.
Mr. Kelly?
Yes.
Chair Sanchez?
Aye.
Okay, the motion passes unanimously.
Okay, thank you. Item C, which sounds like this is also under the same authority. Is this also Dr. Natoya?
Thank you, Madam Chair. This memo
Yes.
comes with a recommendation or a request to approve a $600 per month transportation allowance for the CEO Santos H. Kryman effective July 1st, 2021. This is presented basically to shore up a gap in the documentation. We have a past practice of paying an amount, and Mr. Kryman's employment contract allows for an amount to be paid, but it doesn't specify the amount. So the purpose is to have the board specify an amount so that we can document that the board approved a specific amount.
Move
Okay,
approval.
do we? Thank you. Second.
It's David Green, I'll second it.
Thank you, Mr. Green.
Madam Chair,
Yes,
I have a statement that I have to read.
go ahead.
Okay. So prior to taking final action, the legislative body shall orally report a summary of the recommendation for final action on salaries, salary schedules, or compensation paid in the form of fringe benefits of any local agency executive as defined in subdivision D of section 3511.1 during an open meeting in which the final action is to be taken. This paragraph shall not affect the public's right under the California Public Records Act, Chapter 3.5, commencing with Section 6250 of Division 7 of Title I, to inspect a copy of records created or received in the process of developing the recommendation. So to state it for the record, the amount is $600 in the form of a transportation allowance.
My motion stands.
Mr. Kelly has a question.
Thank you. I see Mr. Kelly's question.
Thank you. I have several questions. How did this issue come up?
How did this issue come up? That we now are attempting to pay Mr. Kryman a $600 transportation allowance. And the question of how did you come up with that amount?
No, it's not the amount. It's how the issue came up. Why did the issue not come up when Mr. Santos returned the car?
So at the time, well, he opted not to have it and then said, okay, well, let's get the car issue resolved. And so we got the car issue resolved, and it took a little while for us to get the financial issue resolved,
What's the financial issue?
the payment of the transportation allowance.
Okay, so here's my really material issue with this. You're asking us to approve a retroactive contract in essence.
Yes, so
And I really, really don't support approval of retroactive contracts. I think that's a really poor practice.
Mhm.
If he forgot, that's on him in my mind. If there were other issues with the car, I don't know what they were, but that's a really material issue. And the other thing is that because this does go back into 21, so you have 21 and 22 calendar years, there's no discussion of impact to taxability here at all. Are you issuing him corrected 1099s or?
No, because it'd be paid currently. So it'd be on this year's his statement.
But shouldn't it have been prior?
No, because it's paid currently. So the issue of, so you bring up a really great issue. Because his contract has a statement, do we have the ability to not pay him? Does he have the ability to refuse the transportation allowance? After discussion, if it's in the contract, it should be paid. So whether he requested it March 1st to say, oh, I would like with my entitled transportation allowance starting March 1st, 2023, we really find that we don't have the ability to not pay him from the time that he returned the car because his contract states that he will have one or the other.
Well, I think there's another phrase in that contractual language, though, that says something about per written agreement or something. Is there such an agreement with him about this item?
There is, but it doesn't specify an amount.
When I looked at this, what I thought it was going to be, quite frankly, was a transportation allowance policy firm-wide, because there've been a lot of concerns over the years about who gets this transportation policy, this allowance, who doesn't, et cetera. Different levels of manager get it. People who travel far, people don't travel far, et cetera. So, and then he would be named in that as an eligible employee, so that this never has to come back to the boards before again. But it wasn't. It was specific to him, and then part of me was, well, why should if you're in charge? Santos is right here. If you're in charge. And you didn't notice you went missing $600, back in 21. Now that's on me or this board to deal with. I was very uncomfortable with it.
Madam Chair, may I address the board?
Yeah, yes.
So Trustee Kelly, another issue that we didn't highlight in the memo is there was internal back and forth with us and the auditor controller, or not the auditor controller.
Auditor controllers and CEO's office.
In terms of our payroll. So that was, excuse me, the reason for the length of bringing us to the board is we were going back and forth in terms of the payroll to try to get the transportation allowance approved for Mr. Kryman, but it hasn't. We've had issues with the county and being able to establish that based on certain pay codes, if I remember right.
So you requested the authority from the auditor controller to pay the payment without authorization from the board?
No.
Well, Steve came up.
Yeah, just to clear, there was discussion with the auditor controller. That discussion was unnecessary because per Searle and per the county ordinance, the authority to determine the CEO's salary and benefits lies exclusively with the LACERA boards, and the county has no say on the subject, and they ultimately acknowledge that. But it took some discussion.
Exactly. And furthermore, it was also the technicality piece in terms of the system recognizing our ability to pay that payment due to the fact that the county oversees our payroll system. So that was the other item that took a while to resolve.
And the $600 came from where? What's the source of that dollar figure?
Right. So the $600 figure is a result of past practice. The last documented approval for $600 came with the employment contract from, I believe his name is David Kushner, Mr. Kushner. And so since the transportation allowance that had been paid $600 to him after his contract expired and he separated, that is the amount HR continued to pay going forward.
But other employees in the transportation allowance program get the same dollar figure?
Well.
And then my second question would be, does that align with IRS rulings in this area if there are any?
So yes, it does allow for IRS rulings about the maximums and also with the county allowable payment through that payroll code. So the amount, the issue about the amount, the $600. We have an administrative policy about transportation and transportation allowances that speaks to your concern about other managers at LACERA being able to be paid a transportation allowance, or have a vehicle. The $600 amount is consistent.
Okay, thank you very much. I'm not going to support the item.
Okay, thank you, Ms. Jones.
I did have a question. It was my understanding, if this has been treated as part of his salary, that we legally have, if an employee says you did not pay me, you should have paid me. I think there's a time period, of course, you know, I don't think we have to go back further than so many years, but don't we legally obligation to pay that amount for payroll related items?
I think you're looking at Mr. Rice
Or
beyond me,
anyone.
but I would say yes. We do. The
That's
issue
been my
is,
experience.
yeah.
You know, we've had errors in the past. In my profession, we've had errors in payroll, and once we've identified it, you know, we were advised by our attorneys that specialize in payroll that we were, you know, legally obligated to pay the amount. I just wanted to know if this is the same.
The complication here is that the CEO's contract specifies that he's entitled to a vehicle or an allowance in an amount to be negotiated. And it only now has the amount been negotiated.
Thank you for the clarification. Thank you.
Okay. We have a motion and a second.
Yes.
Do we have any further comment? All right, go ahead and take the roll.
Mr. Knox,
Aye.
Mr. David Green,
Aye.
Mr. Santos,
Yes.
Mr. Jason Green,
Aye.
Mr. Rue,
Yes.
Mr. Jones,
Yes.
Mrs. Jones,
Aye.
Mr. Kelly,
No,
Ms. Sanchez.
Yes.
Okay, the motion passes with 1 no.
Okay, thank you. So that concludes our non-consent items. We'll move on to reports. Items B through F are for information only unless we have a request to pull them. So we'll
Madam
go.
Chair, I just
Yes.
wanted to, on reports, I just want to congratulate the team on the securities lending program results. They were really stellar this year, mostly due to a number of changes that the team implemented. So I thought the report was great, and thank you very much.
Thank you, Mr. Kelly. Any other comments or requests to pull?
Yes.
Otherwise, yes, Mr.
Um,
Santos.
I just want to mention, I don't see Mr. Wagner here, but, monitor. You know, I look very closely at private equity for several reasons. In my view, that's been the best performing asset class that we had in this portfolio, but also we increased the allocation up to 17%. And looking at the report, it's impressive that we have 22% rate of return for the past 3 years. And that's music to my ears. I know the reporting is lagging, but certainly I'm really impressed with that. Also, with regards to, I discussed to Mr. Rice, Jim Rice, with regards to the real estate performance. I think, given the fact that we made some major changes in that portfolio, which is great news for me, since I always been skeptical about the real estate portfolio performance over the years. But credit to Mr. Grable, who came here and acknowledged the fact that there were some issues that needed to improve. And I think, given the numbers I saw in that report, I think we are looking really good and on our way to make a positive change to the real estate portfolio. So thank you for the great work with the staff. This is the type of numbers that I like to see.
Thank you, Mr. Santos. Okay, moving on to item A, LACERA Quarterly Performance Book, Jude Pettis and Dale Johnson.
So good morning, Chair Sanchez and trustees. The item before you is a presentation on the quarterly performance book covering the fourth quarter of 2022. The quarterly book was included in your package. However, I do want to mention that the presentation, which is made up of all the pages in the quarterly book, was inadvertently left out of the package. It was distributed on Monday and as a green folder item today. So I did want to bring that to your attention. I do want to give some context on performance for some of our newer trustees. Performance is done monthly in the CIO report, as we heard Mr. Grable speak to. And then also we provide a much more comprehensive book 4 times a year, which is in your packet today. And with the quarterly book, it is discussed 2 times a year, one at calendar year end and the other time at fiscal year end. And that's why we have a presentation today. So with that, I'd like to hand the presentation over to John Kim, who is participating via video, and also Tara Elijah to discuss the total fund and risk performance for the fourth quarter of 2022.
Thank you, Jude. Morning. Yes. Good morning, Chair Sanchez and trustees. In today's presentation, we're going to go over the total fund level reports. But as you can see in the full book, we do have sections on each of the various asset categories. And so we also go down to the manager level. So if you ever want to dig down deeper into the portfolio, that's available. We also have a glossary that defines key terms, and that's helpful to refer to as well. So I'm going to start by going over LACERA'S forecast total fund risk information for calendar year end December 2022. Thank you, Krista. Total risk is the forecast, standard deviation, or volatility of returns. Our current risk platform uses a multi-asset class factor model. And based on our exposures to those various factors, and the model uses historical data to derive the forecast, which looks out 1 year's time. So at the top of the slide, you can see the portfolio's forecast total risk is at 13.83%, which is up 94 basis points since our last oral presentation to the board, which was fiscal year end. Increased market volatility has driven that number up each month over the last several months. Shifting to active risk. So it's another key risk metric, which tells us the expected standard deviation or volatility of the return difference between our portfolio and the benchmark. So active risk was at 1.1% for this period, and that was a decrease from the prior period at fiscal year end, which was at 1.4%. And this shift is due to us being closer to our policy benchmark in this period. So at the bottom of the slide, we decompose risk by factor types. So in the model, there are over 3,000 factors. We typically they're typically grouped, as you see, by asset class. The next slide also speaks to factor exposures. So I will skip along now to risk allocation selection. So with the risk allocation selection report, we can explain active risk. So focusing on the table at the bottom in the bold line, the risk allocation comes from the active weights per asset class against their benchmarks. So the larger the weight difference between the benchmark, whether it's over or under, will contribute to more allocation risk. Volatility and correlation are also considered here. Currently, the allocation risk is low at negative 0.01%. And again, that's because this period we're much closer to our benchmark due to active weights shift. Moving into the selection portion of the table, this comes from how different the factor exposures are between the asset class and their benchmarks. As mentioned in this morning's equity committee, the growth within growth, private equity has a public equity benchmark, which is the MSCI ACWI IMI. And within real assets, we have a global real estate portfolio with a US-based real estate benchmark. So because of those selection differences, we see that those categories, growth and real assets, contribute the most to our active risk. So on the next slide, we'll look at our regional breakdown. This slide shows total fund broken out by geographical region, and it breaks apart both total risk and active risk by region. Moving along to our stress tests. I will spend some time here as our team has worked to improve this report. Stress tests on the portfolio are a hypothetical exercise that takes our current portfolio, so in this case, December of 22, and shows our estimated profit loss based on how the markets perform during these event periods. So if a similar market event or market dynamics were to occur, we get an idea of the impact to the fund. So please keep in mind that our actual returns during those historical periods will differ because our portfolio mix was very different in those years. We have now an overlay. We also have more allocation to infrastructure, et cetera, as examples. This quarter, we've added summarized descriptions on the next slide. And each of the scenarios, it helps give more context behind each historical event. We also added here at the bottom, you can see we added 2 COVID scenarios. The first is the sell-off that happened in March of 2020. And the second COVID scenario is the full period that it took for to revert to pre-pandemic levels. So with those examples, you can see that the start and end dates of these events are very specified. Now let's look at the bar chart. So the other enhancement is we show the impact now by asset category to the overall total fund profit loss percentage. Some of the main takeaways here, we see that growth and real assets tend to perform worse during harsh times, while our risk reduction and mitigation portfolio performs relatively better than other asset classes during economic crisis. And this is what the board has intended by design of the strategic asset allocation. Lastly, looking at the newly added COVID scenarios on the far right, the March sell-off had a negative impact on the total fund, while the full pandemic volatility was actually a best case scenario of all the ones that are shown on this page, with significant positive impact to the total fund. At this time, I will turn the presentation over to John Kim to discuss performance and our climate risk profile. Thank you.
Thanks, Tara. Good morning, Chair Sanchez and trustees. We can move to slide 11. Thank you. So slide 11 presents a dashboard view created to provide a quick summary of the total fund to the board. For this quarter, I'd like to highlight a couple of results. So first, our public market fees, which is represented by the pie chart in the top right. Apart from the overlays and hedges functional category, investment management fees declined in excess of 20% year over year. And that's primarily due to lower average market values and manager terminations. Second, our 56% batting average, which represents the percentage of managers that outperform the respective benchmarks for the quarter. Since the metrics introduction in Q2 2021, our managers have surpassed the 50% mark in 6 out of the 7 possible quarters. This trend could serve as an early indication of the quality of diversified managers in our portfolio. Next slide, please. Here we show the performance for various market indices grouped by functional category. And while Q4 performance was generally positive, calendar year 2022 was a challenging year, characterized by slowing economic growth, inflation, layoffs, and fears of a recession that all contributed to negative investor sentiment. So with that, focusing on the one-year return shaded in dark blue, we can see that both equity and fixed income markets experienced significant drawdowns. The allocation to real assets, however, specifically real estate and commodities, were the best performing space for defined benefit plans in 2022. Moving to the next slide. So with that overview, we'll move forward with the review of our asset allocation. We closed the year with a total market value of $70.1 billion. That's up 4% from the prior quarter, but down 7% year over year. Our largest underweight was the growth functional category below its policy target by 2% or $1.4 billion. We expect this underweight to be addressed with the onboarding of the Global Equity Emerging Manager Program, as well as new commitments to private equity and non-core real estate funds. Next slide, please. Slide 14 presents the total funds performance summary page. For the quarter, the total fund grew by 4.1%, beating its policy benchmark by 60 basis points on a net of fees basis. For the calendar year, the total fund declined by 5.6%, but outperformed by 520 basis points as all functional categories generated strong excess returns. These results are further illustrated in the peer ranking table on the bottom right. And just to note that this summary table is gross of fees and is provided by our custodian. A similar net of fees version is provided in Makita's report. Although each report has slight differences, both convey the same message. In periods of short-term equity market rallies, the total fund may finish lower compared to plans with larger tilts to public equities. But over the long term, LACERA'S total fund consistently ranks in the top quartile, a signal that our asset allocation is well positioned and functioning as designed. Moving to the next slide. So the next two slides further analyze the 4.1% quarter-to-date net return for the total fund. And we'll start with a return contribution analysis presented on this slide. So a return contribution analysis identifies the functional category that had the largest impact on the total fund. And as we can expect, the largest positive contributor was the growth composite as equity markets rallied in the fourth quarter. The growth category accounted for more than 70% of the total fund's net return. Moving to the next slide. So slide 16 presents a return attribution analysis, and this breaks down active return into two main parts: allocation and selection effects. So the assumption here is that investors are first deciding target weights for various groups, the allocation effect, and then selecting managers within those groups, the selection effect. Similar to the prior slide, growth was the primary driver of the fund's total value add, largely attributed to the composite selection effect. But in contrast, real assets and inflation hedges was the primary detractor due to a negative interaction effect. In this instance, the negative interaction effect can be thought of as a dampening of the composite's total value add that results from the combined effects of asset allocation, manager selection, and other operational decisions made. If we can move forward 2 slides. Our closing section is an update on LACERA'S ESG and climate profile. As a reminder, staff has been using third-party ESG and climate data analytics to monitor LACERA'S public market managers. Currently, we can evaluate the climate profiles of our public market investments and real estate portfolio while engaging with these managers on how certain ESG factors are considered in their portfolio construction process. The summary table on this slide is an example of how we're using this data to gain insight into the portfolios relative to their benchmark and among similar mandates in the portfolio. The team is pursuing several approaches to expand coverage for private market assets so we can provide a more comprehensive view of climate-related risk and opportunities. This concludes our presentation. We thank you for your time. Open the floor for any questions or comments from trustees.
You caught me eating. Mr. Kelly.
Thank you. There's a slide at the very end of this. I can't remember, it's on page 202 or something. That speaks to the benchmarks used for different asset lines. And I looked at it, and there was a asset. Yeah, given the complexity of kind of index construction that we learned about this morning, I thought, how do I know that? This is a question for Jude. How do I know that the benchmark you've chosen for a certain asset line, you've chosen because it favors the performance rather than it actually is a truer alignment with underlying asset configuration?
Okay. Chair Sanchez, Mr. Kelly, as we go through the strategic asset allocation process, the board, we'd also, once we set up our, we go through capital expectations, we run the model, and we come up to what our expected returns. And the next part of that exercise is to go through and decide what policy benchmarks we should use. And a lot of times those policy benchmarks are what you used as kind of the beta of our portfolio. So it's done beforehand before we do the selection of the manager. I don't know if that answers your question, but the benchmarks are usually in place before we put the mandate.
Yeah, I get that. Makita, do you look at that also, right? the
Yes, we do a
appropriateness of the
presentation
benchmark?
as following up on the strategic asset allocation decision. It's a benchmark review and approval process, and that all gets incorporated into the IPS at the same time. So all the new targets for the asset classes with whatever benchmark modifications were made, all gets baked into the IPS immediately following that. So we do a presentation with staff on that immediately following the strategic asset allocation.
I'll sleep better tonight.
Thank you. Mr. Santos, your hand went up and then down. Just want to make sure that wasn't a technical glitch.
No, once the consultant spoke up, that's what I was going to do. I was going to ask a consultant to opine on that.
Got it. Okay, thank you. Ms. Jones.
Good morning. Excellent work, excellent presentation. I just had a very quick question on the peer ranking section. I wanted to get a sense of the number of entities are involved in this peer ranking. You know, I see the percentiles and where we fall, but is this across the country or in the state of California? I was just curious. What?
Yeah, Chair,
Yep.
Chair Sanchez, and Ms. Jones, Trustee Jones, it's US based is on this peer ranking. I can get you probably within the next 5 minutes, the actual number of plans that contribute to this peer ranking. So we do have that, and maybe as a footnote going forward, we'll list that on the page, but I do have that information and I'll get it for you.
You. Any further questions? Okay, thank you. Hearing none, we will then continue with the agenda. The next items are for information only, so we're at items for staff review.
Ms. Sanchez, there is one item, however, Mr. Grable is going to address that at the good of the order.
Okay, thank you. And I believe I also asked for a review of the pacing policy to be made at another, unless that's the one that's being addressed in the good of the order.
John, that's the one that, or he can go.
Madam Chair, it was, so you asked a question during the CIO report about private equity inflows and outflows. I have that number.
Okay, thank you. All right, great. Items for future agendas?
Oh, I think that's all we have. We don't have anything else.
All right, with that, we'll go to the good of the order.
Okay. Mr. Knox.
Good morning, everyone. Nice to see a full house. Welcome to Mr. Rube.
Thank
Thank
you. Mr. David Green.
Great to be here in person. Great to see everybody. Terrific to be back in the boardroom. Really great to have so many Greens, Jones, and now an extra David to our ranks. Really terrific. Well, welcome, David. It's great to have you here. You're gonna play a huge role in this board, and we're really proud to have you as part of our team. And as always, thank you to Linda for keeping us all on track and all the hard work she does behind the scenes. Thank you.
Thank you. Mr. Santos.
Just thank you. I'd like to echo Mr. Green's comments. Welcome, Mr. Rule. Appreciate that. Like Mr. Green, as a member and beneficiary, we thank you. I personally thank you on behalf of 100,000 members that I represent, as well as 70,000 retirees for your service here. I think it's very important that we have you on board to provide your wisdom. Feel free to ask any questions, any comments. We welcome that because it's very important to us that you fully participate in this board. So welcome. Looking forward to working with you. Also would like to ask my colleagues and everybody here to wish Mr. Green, David Green, birthday. He's finally 21 years old. So happy birthday to you. Happy birthday to you. Happy birthday, Mr. Green. Happy birthday to you.
Thanks so much. Thank you.
Thank you, the staff presentations. Really appreciate it. Have total confidence in the work you do. And Mr. Grable, always thank you for all the work that you do for us and for the fund. So you have a great afternoon. Thank you.
Thank you, Mr. Jason Green.
Yeah, I just want to echo some of the comments. Thanks to the staff for putting together such a really good package to inform us all. And Linda, thanks for the help and whatnot. And I'm just glad to be here. Thank you.
Thank you, Mr. Rue.
Thank you. It's a pleasure to be here and pleasure to serve. I'm keeping in the tradition of keeping all the same names. So to add more confusion to the group, but everyone's been so friendly, all the staff, the executive staff, the support staff, all the members. I haven't gotten a chance to meet every single one of you, but today I'm going to at least come by and say hello. But it's exciting. There's a lot to absorb, and I really thank you for everything you guys have done for years and decades. And I hope to contribute and be part of the team. Thank you.
Thank you, Mr. Jones.
It's nice. I remember my freshman day as well. And so it's nice that we've added a few additional folks onto there. So welcome, David. Likewise, echo the staff for the great work that just so you know that as you prepare that stuff, quite a few of us go through it in great detail through there. So I hope you don't ever feel like the work and the details you put in aren't actually reviewed. But I think most of us just try and spare you from some of the boring questions around call center stuff and things of that nature. I can do that privately. But I just want you to know that that stuff is appreciated. And then finally, to all of us who have teams that may actually make it to March Madness, good luck to you. Go Blue Devils, Duke. All right.
Thank you, Mrs. Jones.
Oh, I want to also welcome the new members, Mr. Rue, Mr. Green. I'm not the newbie anymore. So now I just say, welcome aboard and put your seatbelts on because it's a good ride, but so much information. Like the presentation this morning was excellent. I feel like I'm smarter and wiser based on the information on learning about, how the index funds work. So I really appreciate the information staff. And it was funny because when I looked at the presenter, I was like, how did they get her to come to present? So, thank you staff for bringing really quality speakers to the table to educate us. Also, one of the reasons I had asked about the peer ranking is I just don't want the members to really take for granted how well the investment portfolio is doing. When you see the quarterly report and you compare it to all the other pension plans across the US, I mean, we're in an elite group of at the level of performance that we're operating at. So, and that goes kudos to all the staff that are involved in, day-to-day operations, and then also to the trustees for the, as you were saying, Trustee Jones, he's Trustee Jones too. All the hard work that, we go into reading the documents and understanding the information and making decisions that are, best for the plan. But so I just wanted to say, because the report that we just read, the quarterly report, during a time in, at the end of December, things were not doing well. And so to see how well the plan did is really comforting. And I hope the members really appreciate all the effort that's going into it. And I'm sure they do. But with that, thank you and see you.
Thank you. Mr. Kelly.
Good morning. I have a few items. In the January meeting, I referred to Mrs. Sanchez as the first woman of this board. Subsequent to the meeting, I learned that statement was not correct. Ms. Sandra Anderson, a retired member of LACERA and a former BOI trustee, was this board's first woman chair and served as such for several years in the early 2000s. I would like to correct the record and acknowledge Ms. Anderson's service to this organization. Second, I've decided not to run again for the seat I occupy in this upcoming election. While I'm honored to serve as the elected representative of this agency's nearly 72,000 retired members, My role as a trustee conflicts with several professional objectives of mine that I wanted to achieve in my retirement. 3, welcome to my colleague. Just so you know, Bonnie has expectations that you and I will become quite friendly. So please, please act accordingly.
Linda, not Bonnie.
Linda, sorry. Happy St. Patrick's Day, March 17th. Get in touch with your inner leprechaun. Finally, I can't believe the gay guy is the one who talks about International Women's Day. Today is International Women's Day, a global holiday celebrated annually on March 8th as a focal point in the women's rights movement, bringing attention to issues such as gender equality, reproductive rights, and violence and abuse against women. My neighbor this morning, when I told him, said, "Why does it matter?" And I reminded him of Shirley Chisholm's famous quote, "The emotional, sexual, and psychological stereotyping of females begins when the doctor says it's a girl." Thank you very much.
And some of us is wearing pink today.
Thank you, Mr. Kelly. John?
Thank you, Linda. A couple of things. One, I want to thank Mr. Kelly for his service. Welcome, Mr. Rue. Wish Mr. Green a happy birthday. And I guess I'll just say it. LACERA, we should not audition for The Voice. So I also want to thank the team. Each month we put together a package, and I think each month the board materials get better, more referenceable, easier to digest. So I just want to thank the team for doing this day in, day out. Let's see, a couple other things. One is during the CIO report, Ms. Sanchez asked about kind of capital flows over the last several years in private equity. Since 2020 through September of 2022, about $5.5 billion has been called from our private equity managers, and that compares to $5 billion being distributed. So there isn't a huge change in terms of the NAV in our portfolio, even though it's performed quite well, and the NAV has increased towards the point that Mr. Santos is making earlier, basically driven by performance. The last thing that I will mention is that there is another doctor in the house, and maybe I could just turn around for a second. Yes. And David Simpson just received his PhD. So we have Dr. David Simpson in the audience. He received his degree. His doctorate in business administration from the University of Liverpool. So I did the thing that most people would do. You go on the internet and you look for some fun facts about the University of Liverpool. None of the Beatles went there, but there are 9 Nobel Prize winners from the University of Liverpool, including one in economics. So maybe behind me we have number 10 sitting behind us in Dr. Simpson. So congratulations, Dr. Simpson.
For sure. Speech.
Chair Sanchez.
Thank you. So Mr. Kelly stole my thunder, but thank you for that. It is International Women's Day, and it is an important day to remember that we still have a significant portion of the population in the globe that remains underutilized, underpaid, and often underrepresented even within the GDP of the economies that they represent and do unpaid work for. So I do want to underscore that. Thank you, Mr. Kelly, for the excellent opening, and I'll bring it home. And of course, I do want to, we have an official freshman class now with Trustee Ryu and Trustee Green, and you're off and running, and we're looking forward to continuing to support your journey. And thank you, as always, to the staff for continuing to improve the materials that we see, and for doing an excellent job of answering the questions that we have for you. And I have actually said this many times privately in conversations, but I would like to take a moment to say this publicly. we have some of the best, I think, presentations that are presented by staff. And I think part of it is that, you know, Mr. Grable has an incredible talent for creating presentations along with his staff. So I have said this many times actually to people at conferences and whatnot, and I was praising you yesterday. So I thought I should take a moment to praise you on the record. So I just want to thank you for putting such thought into how you visually represent often very complex ideas. Thank you.
Okay, executive session is next.
Great. Do we just need a few
Recording
minutes to
stopped.
prepare?
Yeah, we just need like 2 minutes.
Okay, great.
Okay.